Hello learners, I am Dr. Nidhi Mathur and the subject expert is Dr. Neeti Mathur, teaching in National Law University, Jodhpur, Rajasthan. Today we are going to talk about the backbone of globalization. Yes, you guessed it right, the financial environment. We all know that finance is the lifeblood of business and it becomes of immense use when it comes to international business. Multinational companies invest a lot of money to cater to the needs of global customers. In this lecture and coming lectures, we will discuss at length how this finance is arranged and managed by the multinational companies. Before we get into that discussion, let us understand what is business environment. Business environment in general comprises of multiple factors, individuals, entities that may or may not be in control of a company, but it affects or influences a company's performance, growth, profitability and even survival. For example, employees, vendors, suppliers, wholesalers, retailers, consultants, directors, investors, media, government, customers and even technologies used, management tools and practices, economic conditions, market conditions, trends, all are included in the business environment of a company. The interdependence of a multiple source in the ecosystem of a business makes its environment very important. All the way from establishing a company to sustaining it depends upon resources like finance, social norms, labor, raw material, product, services, etc. Classification of business environment. Business environment is majorly classified into two types: internal environment, external environment. External environment, which is further divided into two parts, micro environment and macro environment. Internal environment, all the internal factors of the business or the factors that lies within the ambit or control of the company comes under internal environment. The components of internal environment are directly controllable and major components are plans and policies, properly framed plans and policies considering the resources and aims of the company helps the firm to fulfill its objectives. Human resource, quality of human resource played a vital role in company's success. If the employee of the company are firm with characteristics of human resource such as morale, commitment, quality and skill, it can contribute greatly to the success of a company. Financial resources. Finances is lifeblood and oxygen for every business. It relates to money. Financial factors like financial policies, status, structure influences the internal environment of a company and thus affects the performance. In order to spend on research and promotional activities, sufficient financial resources is a must. Corporate image. developing and maintaining a good corporate image in the minds of employees, customers, investors, etc., is very essential for a company. By undertaking constant research and development activities, companies can strengthen its standard and brand quality, and it helps in creating a good corporate image. Plants and machinery. Keeping the plant and machinery updated is necessary for a company as it is an important internal part of a firm. Old and outdated machinery adversely affects a business firm. Labor and management relationship. If the management understands the problems and concerns of labor, it enables them to function smoothly. It increases the morale of employees and motivates them to put efforts. Employees should be motivated through both monetary and non-monetary benefits for the overall development of the organization. Next is external environment. All the external factors of the business or the factors that lies outside the origin comes under external environment. The components of external environment are unpredictable and beyond the control of the company. It is further classified into two parts: microenvironment. It consists of the elements that directly influence the performance of a company. Major elements are customers. They are the king of the market, which makes them the absolute centers of the business. Identifying their needs, wants, likes, dislikes, and meeting their satisfaction leads to success of a business. Proper research and development measures should be taken by a firm to identify the requirement of their customers. Competitors. Identifying competitors and monitoring their activities in terms of their products, prices, promotion and distribution strategies is very important for a company to stay ahead of the competition. The world has become a global market with the increase in privatization, liberalization and globalization. Understanding the competitors' activities and strategies plays a vital role in the company's success. Suppliers. Maintaining good relation with suppliers is another important aspect, as they are the ones responsible for supplying raw materials, machines, equipments, etc. Keeping a check on the quality and pricing of the supplied machinery, equipment, material, etc. is very necessary. A company should never rely on a single source of supply, as irregularities and uncertainties of supply can result in higher inventory costs and losses. Society. It includes financial institutions, shareholders, government employees and general public. Expectation of the society affects decision of the company. And that is why business firms have public relations department to deal with the complaints, grievances and suggestions of the general public. Macro environment. Demographic environment. It relates to human population with reference to density of population, age composition, sex ratio, family size, income level, status, educational levels, etc. These demographic factors have notable consequences on business. Studying them in detail is essential as business deals with people. Economic environment. It is very dynamic and complex in nature and include economic factors like economic system, policies and resources, inflation rate, trade cycle, GDP, employment, balance of payments, interest rates, consumer income, etc. Though international financial environment will draw most of its relevance from economic environment, but since we know that finance is the lifeblood of business, all macro and micro components of business depends upon the international financial environment directly or indirectly. Technological environment. It is the most rapidly evolving factor in the business environment and constantly brings changes in the method of production, quality of goods, productivity, packaging, etc. It helps businesses to develop better and faster in this competitive environment. Cultural environment. Society affects the decisions in business, and since society is highly influenced with culture, it influences business too. It is important for a business to be organized and governed in accordance to the cultural factors like knowledge, morals, beliefs, customs, values, traditions, laws, etc. Political and legal environment. Political environment influences the law-making entities, executives, judiciary, who are responsible for setting up the legal environment for business by implementing laws and regulations within which a business has to operate. Being knowledgeable about laws and policies helps in running business smoothly and effectively. Natural environment. It is comprised of fundamental factors like land, water and mineral, and also includes factors like natural resources, weather, climatic conditions, topographical factors like soil, sea, rivers, rainfall, etc. Natural factors need to be considered before starting any operations. Interconnection of internal and external business environment. There is a significant relationship between the internal and the external business environment of the company. Internal business environment of a company has a dependency on its external environment. The general environment or the macro external environment influences the coordination of the internal environment comprised of owners, board of directors, employees, culture, etc. And the task environment or the micro external environment comprised of strategic partners, suppliers, regulators, customers and competitors. The interdependence and interconnection creates the need for the business managers to understand the various dimensions of the impact caused by the external environment, which directly governs the flow of operational activities of a firm. Any change in the general environment directly influences the task environment, and the internal environment of the company needs to change and develop in accordance to adjust with the evolving external environment. Thus, both internal and external business environment needs to be understood together due to functional dependency, and the growth of any organization requires their managers to analyze both to achieve organizational effectiveness. Now, let us discuss the role of globalization in shaping the requirement of international financial environment. Globalization can be defined as the interdependency and integration of people, companies and governments all over the world. Occurrence of globalization in terms of society, culture, politics and legalities leads to increased interconnection of national economies. In economical terms, the spread of jobs, products, services, technology, economic resources and information across nations is globalization. It has been predominantly consequential in financial markets such as capital markets, money and credit markets, insurance markets, commodity markets like oil, gold, coffee, etc., and product markets like consumer electronics, motor vehicles, clothing and apparels, etc. The concept of globalization is not new. However, it has been grown exponentially post 19th century due to rise of industrial revolution leading towards better transportation and communication, resulting in ease of trade across borders. Through fiscal policies and trade agreements, governments worldwide have systematically unified a free market economic system in last 20 years. This has also encouraged governments to focus on promoting international commerce as evolution of economic systems has increased industrial and financial opportunities in many nations. Advantages of globalization: access to new cultures and new markets. Globalization has made it easier for people across the world to have access to foreign culture, including food, music, movies, art, sports, etc. And this has created an opportunity for businesses to grow in the overseas market. They get new customers internationally and diverse revenue streams. Spread of technology and innovation. Most of the countries are constantly connected with each other, leading to spread of knowledge, information and technological advances across nations. Due to this, the concept or technology developed in one country can be worked upon in another country in a matter of days. Lower costs for raw materials and products. Globalization facilitates worldwide access to cheap sources of raw material, which leads to reduced production cost, and due to increase in global competition, the product prices stays down, reducing monopoly profits, and consumers get large variety of choices and an option to live better on less money. Creates more job opportunities. Globalization enables companies in developed countries to hunt for talent and opportunities in developing countries, which brings jobs and technology to developing countries and helps in growing their economy. Disadvantages of globalization: inequalities in income and wealth. Globalization leads to urban-rural divide in some countries, which leads to social, political and financial instability, as most of the world's poorest people do not have access to basic technologies and public goods. Rise in rate of inflation. Commodity prices have shown a huge rise due to increasing demand for food and energy, eventually rising the rate of inflation, putting world's poorest people at a greater risk of survival, as food is a basic need. Vulnerability to external economic shocks. Interdependency and interconnection in national economies leads to a threat of economic downfall due to external events, as countries are more vulnerable to face the effects of macroeconomic problems elsewhere. Domination of multinational giants. Globalization enables giant firms and multinational companies to dominate the domestic markets in many countries, and this becomes a drawback and a barrier for local manufacturers and producers to enter or survive in the market. The increase in power and influence of multinationals leads to manipulation in the market, and thus seen as a major disadvantage of globalization. Need for international finance. A rapid rise in globalization has augmented the importance of international finance as it deals with management of finances in global markets. In simple terms, international finance is the study of macroeconomic interrelations and monetary transactions happening between two or more countries. It focuses on examining the dynamics of exchange rates, foreign direct investments, balance of payments, international monetary systems, global financial systems and their relation to international trade. International trade of goods and services is the most significant factor in the growth of economies of participating nations, and international finance plays a vital role in it. Some noteworthy reasons are: it helps in the calculation of exchange rates of various currencies and their relative value against each other. It enables the comparison of inflation rates, which gives an idea about investing in international debt securities. It helps in determining the economic status of various countries and judging the foreign markets. International financial reporting system is a part of international finance that facilitates comparison of financial statements made by various countries. International finance organizations such as IMF, World Bank, etc. act as a mediator in case of financial disputes amongst member nations and provide resolution for the same. It helps in understanding the basics of all international organizations and keep them in balance. The study of international finance is very important due to its significance in the international trade. The existence of international financial system raises the possibility of international financial crisis, which makes the understanding of international finance necessary. International finance helps in keeping international disputes of any kind in control and is responsible for maintaining peace amongst participating nations. The finance function of a multinational corporation. Finance function is an integral part of financial management. Financial management deals with controlling and planning of the financial resources of a company. In general terms, finance function serves the purpose of being a treasurer and controller of financial resources for the company. It can be classified into 6 major roles in the financial management of a company: financial planning, forecasting cash needs, that is inflow and outflow, raising funds, allocating funds, effectual use of funds, financial control. In the case of multinational companies, since the scope grows beyond the domestic market, it requires a financial management system strong and capable enough to manage international transactions and currency risk exposure of its operating units and the company as a whole. Finance function of a multinational corporation also serves its sole purpose as a treasurer and controller. Treasurer is responsible for planning analysis, fund acquisition, risk management, cash management, investment financing, investment decision. Controller is responsible for external reporting, tax planning and management, management information system, financial and management accounting, budget planning and control, accounts receivable. Managing international finance is a complex task as there are multiple financial instruments, products, funding options and investment vehicles are available all over the world. Firm has to take international portfolio decisions analytically to raise funds from different financial markets all over the world, maximize return on investment and minimize the cost of finance. In order to achieve this, the finance function of a multinational company has to perform several functions in relevance to international operations: determining comprehensive financial goals and strategy, managing and financing domestic and international trade, stabilizing and managing the financial flows, identifying, quantifying and managing the currency risk exposures, developing procedures and establishing policies for operating divisions to maintain flow of interaction, coordinating firms' interaction with customers, suppliers, investors and host governments. Let us now understand why international finance is important for Indian companies operating or serving abroad. For this, let us understand our international trade scenario. International trade plays a significant role in the economic growth of a country. International trade in India comprises of all the exports from and imports to India. It is managed by the Ministry of Commerce and Industry at the central level. International trade is an effective mechanism for financial growth, job opportunities, and reducing poverty in an economy. Doing business with foreign nations is not a new thing for India, and these business histories dates back even in BC. Since 1498, Europeans did trade with Indian rulers using sea route. International trade in India paced up in the later half of the 19th century. From 1947 to 1991, the Indian economy largely remained as a closed economy. Taxes on imports were excessively high, and even FDI were restricted post 1991 due to liberalization. The international trade started to improve in India. Exports and imports. India is exporting around 7,500 commodities to almost 190 countries, and it is importing 6,000 commodities from about 140 countries. It even has exports and imports in terms of service apart from commodities. Balance of trade is equal to export of goods minus import of goods. Majority of the trades of India are with countries such as USA, China, UAE, Hong Kong and Saudi Arabia. India's overall export, that is merchandise and services combined, in April to September 2020 to 2021 are estimated to be USD 221.86 billion, exhibiting a negative growth of 16.66% over the same period last year. Overall imports in April to September 2020 to 2021 are estimated to be USD 204.12 billion, exhibiting a negative growth of 35.43% over the same period last year. Foreign direct investment is defined as an investment made in business in one country by an individual or a firm based in another country. FDI inflows. It plays a significant role in the development of Indian economy. Higher FDI is directly proportional to higher employment in the country. FDI equity inflow of India for fiscal year 2020 is about $50 billion. FDI outflow. Outflow data remains active status in CEIC and is reported by Reserve Bank of India. FDI outflow of India was reported at $1.539 billion in September 2020. So that is all for today. Hope you have understood. We will meet in the next episode with a new topic to take understanding of international financial environment at a deeper level. Till then, take care and goodbye.